Miu to start the second session of the day on the targeted financial sanctions in practice. And I will now share the presentation on that as well.
Great, thank you very much, Wojciech, and thanks to everyone who is on the call still. I hope you had an enjoyable break. I certainly needed some coffee, but good to be back. So the next session will look at targeted financial sanctions obligations and what it means to implement targeted financial sanctions in practice. There was a few questions about reporting requirements, a few questions about what are we meant to be doing, where can we look for entities that are involved in proliferation financing, what are our screening obligations or sanction screening obligations, and this presentation will deal with some of that. I will, however, caveat that we will not be talking about the domestic legal requirements which have recently been passed in Cambodia, because that will be communicated from your own regulator in Cambodia. So we are talking about what a targeted financial sanctions obligation means at the international level and the obligations that are attached to the implementation of targeted financial sanctions. But please, you do need to consult the PF law and the domestic legal obligations and processes that are established in Cambodia to fully implement this in practice. If you have any questions, please submit them. Great, so the overview of this session, what I will go through, it's a quick session. I will briefly outline international proliferation financing obligations. There was a question earlier in the last session in the Q&A about the difference between economic and financial targeted sanctions, targeted financial sanctions, and I will briefly touch on that there. So the sanctions that exist that are economic or sectoral or activity-based that exist outside of targeted financial sanctions. I'll briefly talk about that. Then we'll talk about the targeted financial sanctions framework, what that means in practice, asset freeze. We'll talk about arms embargo, and we'll talk a bit briefly about travel bans as well. Right, so the next slide, I think it's worth stepping back a little bit and talking about what are sanctions, because when we're talking about legal requirements on sanctions, it's important to establish what they are and crucially what they're not. So as I've mentioned already, the UN has imposed sanctions to prevent and counter the proliferation of weapons of mass destruction. So sanctions are not in and of themselves meant to be punitive. They're not meant as punishments, they're meant to prevent and counter activities from happening. So the UN imposes sanctions to make it harder for proliferators to operate, therefore targeting the financing, for example, or the transport or the procurement that they're able to do, or the sectors that proliferators are able to operate in, but also counter and encourage the proliferation of weapons of mass destruction, encourage that behavior to reverse. So it's important to note that sanctions are directed at countries, individuals, or entities. And for targeted financial sanctions, they're specifically focused on specific individuals and entities that have been identified as being involved in proliferation financing activities. Sanctions generally do not require a finding of criminal guilt or civil liability. So it is not a court process to be sanctioned. It is a decision made by the UN Security Council, with the legal basis being in Chapter 7 of the United Nations Charter, meaning that all UN member states are required to implement these measures. Each member state will take the sanctions measures and transpose them into their domestic legal framework. And that is the proliferation financing law that was referenced earlier in the call that Cambodia has recently passed, that will seek to ensure that targeted financial sanctions related to proliferation are implemented in Cambodia. So you as private sector, you do not implement directly UN measures, you implement those UN measures through the transposition of those measures into Cambodian law. So there are a range of counter-proliferation financing measures at the UN Security Council. On the next slide, I provided an overview of all the different legal measures and what we consider to be a comprehensive counterproliferation financing framework. And you will note that targeted financial sanctions is only one part of this. So while the training today and while the rest of the session will focus on targeted financial sanctions, I do briefly want to talk about the other kinds of financial prohibitions that exist at the UN level so that you are aware of them and that you're aware of the broader context in which targeted financial sanctions exist. We have general prohibitions against proliferation financing and prohibitions against financing certain controlled items. That is established in UN Security Council Resolution 1540, but there are no targeted financial sanctions attached to that resolution. We also have specific prohibitions on financing certain items to and from the DPRK. That includes certain sectors of export like coal or seafood or textiles, where the financing of that export is specifically prohibited. And then we have what we call other financial measures or activity-based measures, both for Iran and for the DPRK. For the DPRK, it is, for example, certain relationships with DPRK financial institutions are prohibited. Certain insurance activities are prohibited. For Iran, it's certain activities connected to ballistic missiles specifically. However, all of this really connects back to your targeted financial sanctions, because many of the activities in the first 5 pillars will also be covered in a way by targeted financial sanctions. So targeted financial sanctions at a baseline only refers to specific entities and individuals that have been targeted in their own right. So not a specific activity or a whole sector or a certain prohibition on the export of goods. It is a person or a company that has been designated by the United Nations for their role in proliferation financing. However, often we will see these designated entities and individuals being targeted and designated because of their involvement in other types of activities. So because these entities have been involved in exporting controlled items and financing the export controlled items, or because these entities are connected to North Korean financial institutions, most North Korean DPRK financial institutions are now in themselves designated. So actually targeted financial sanctions, the people on that list are often on the list because of their involvement in the previous 5 pillars. The last 3 pillars in purple are the bits that make the system work. And this is really the domestic transposition of these measures. So it's about setting up a monitoring and enforcement framework domestically. It's about domestic coordination, both between government agencies and between the public and the private sector, the issuing of guidance to the private sector, for example. And it's about international cooperation between countries. We will not deal with the 3 purple pillars today. We will also not deal with the first 5 gray pillars today, because the purple pillars are really about your domestic legal framework in Cambodia. And the first 5 pillars are not mandated by the FATF. What we will be focusing on is targeted financial sanctions, which is what the FATF, the Financial Action Task Force, requires the implementation of United Nations targeted financial sanctions related to proliferation of weapons of mass destruction without delay. Targeted financial sanctions order encompasses both an asset freeze, a travel ban, and often also an arms embargo. And currently, there are 2 countries where targeted financial sanctions related to proliferation are relevant to. The first one is the DPRK, also referred to as North Korea, and the second is Iran. Great. On the next slide, you will see an overview of the legal orders in the UN framework that establishes these targeted financial sanctions. The first, related to Iran, is UN Resolution 2231, which was passed in 2015. And this resolution is in place until October 2023, or earlier if provided by the UN Security Council. You may remember that in 2015 was when we agreed as an international community to the Joint Comprehensive Plan of Action, whereby all prior UN Security Council resolutions and all prior sanctions established at the UN level against Iran were lifted and replaced with 2231. So there are still, despite the Joint Comprehensive Plan of Action, there are still certain persons and entities that are still listed under UN Security Council Resolution 2231, and they're contained on what we call the 2231 list. So that list contains the names of entities and individuals that still have targeted financial sanctions related to proliferation against them until October 2023, when the Joint Comprehensive Plan of Action mandates that those sanctions too are lifted. The second regime, and perhaps the bigger one, is the DPRK. The first targeted financial sanctions against the DPRK came with Resolution 1718 in 2006. And since then, there has been a number of successor resolutions that have added to the designations. So we've had a number of resolutions that have added more entities and individuals to that list. And the names of persons and entities that are currently listed related to DPRK proliferation are contained on the 1718 list. Great. So I also talked about the FATF, the Financial Action Task Force, and the role that they have in all of this. And the reason that we're having this training today, and the reason why the Proliferation Financing Law was passed, is because of a requirement of the Financial Action Task Force to implement United Nations Security Council resolutions and implement without delay targeted financial sanctions against designated entities and persons. The resolutions require countries to freeze without delay the funds or other assets of any person or entity designated by the UN Security Council under Chapter 7. So essentially, the connection between these two is that the UN establishes the targeted financial sanctions related to proliferation, and the FATF mandates that every country implements them without delay and monitors for that implementation. And Cambodia, being a member both of the United Nations and of the FATF through its membership of the Asia Pacific Group, which is the local regional FATF-style regional body in the Asia Pacific region, Cambodia is implementing both of these regimes, and that is why we're here today. Great. On the next slide, I want to talk a little bit more about what targeted financial sanctions requires countries to do. And there are two aspects to a targeted financial sanctions order, which are both relevant to the private sector. The first is a requirement to immediately freeze the funds and other assets. So remember that funds and other assets is not just about cash in a bank account, it's also about property, it's also about vessels, it's also about stocks and shares, letters of credit, any document that indicates a value or holds value in any form. So those funds and other assets needs to be frozen immediately if they're in Cambodian territory and they're owned or controlled directly or indirectly by persons or entities designated by the UN Security Council. It also requires the freezing of funds, other financial assets, and any economic resources of any persons or entities acting on behalf of or at the direction of those designated by the UN Security Council. So it actually goes a little bit further. It's not just about the people on the list, it's also freezing the funds of those who are connected to the people on the list. And we will talk a little bit more about this in 2 or 3 slides' time. The second aspect to a targeted financial sanctions requirement is to ensure that any funds or other assets are prevented from being made available to designated persons or entities, or for the benefit of designated persons and entities. And this is slightly different from an asset freezing order. So asset freezing order are, say, if I hold money in a bank account, the asset freezing order would freeze those funds in my bank account and prevent me from accessing the funds. the order preventing funds from being made available to me, or financial services being made available to me, essentially bars me from receiving or sending or being involved in any kind of financial transaction or any kind of financial service or any kind of financial product, anything that contains value in the FATF definition sense. So hopefully that makes sense. And both of these are relevant to the private sector. So we've got, on the next slide, we've got your UN measures, targeted financial sanctions that requires, and the FATF mandating the implementation of those measures without delay. And both of those are transposed into domestic law, into Cambodia's PF law, which was recently passed. So I encourage you to consult that law to see how specifically targeted financial sanctions are interpreted and implemented in Cambodia's law. What I have referred to now is simply the international legal requirement. Great. On the next slide, I want to elaborate a little bit further on what I mean by those connected to designated entities and individuals, because this is an important part of targeted financial sanctions and it's an important part of private sector implementation. This is also often what causes the most difficulties for private sector. So if you were given a list of 100 people who you had to put an asset freeze in place against, and who you can't make funds available to, that is a very easy exercise, because all you need to make sure is that you don't provide any financial services to those 100 people on the sanctions list. However, because we know, and as outlined in the first presentation of today, we know that targeted entities, so the persons and entities on the sanctions list, will not operate under their own name. They will set up front company networks, they will set up circumvention methods, they will enlist the help of other people in order to continue to access the financial system and continue to access funds. Because of this, targeted financial sanctions actually have a broader scope than just the 100 people on a list. It applies not only to them, but also the persons and entities linked to them. So that means that when you have a listed party, you also have to enforce an asset freeze and a prohibition on making assets available to anyone who is acting on behalf of the listed party, anyone who is acting at the direction of a listed party, anyone who is owned by a listed party, or anyone who is controlled by a listed party. Some of these can be easy to define. It's sometimes in some jurisdictions than others, depending on how much access you have to ultimate beneficial ownership. It's easy to establish whether one of your clients, for example, is owned by a listed party, or a listed party has a controlling share in one of the companies that are one of your clients. However, some of these can also be more tricky. Acting on behalf of, how do you define if someone is acting on behalf of a listed party? That could simply be an email from a listed party instructing, giving instructions to the person who is acting on behalf of them, or acting at the direction of can also be quite murky. And this is what makes it really challenging for the private sector sometimes to find out and find all aspects of sanctions evasion and fully implement targeted financial sanctions. But it is important to note that the scope of targeted financial sanctions actually requires you to also consider these entities that are acting on behalf of or otherwise connected to the designated entities, and asset freezing provisions would also apply to them. So one more click on the next slide. It's worth noting that for the DPRK, again, there are enhanced definitions of targeted financial sanctions and the scope of targeted financial sanctions when it comes to DPRK. The UN has also established that any funds or other assets that are owned or controlled by the government of DPRK or the Workers' Party of Korea, which is the governing party of the DPRK, and anyone owned or controlled acting on behalf of or at the direction of the government of DPRK or the Workers' Party of Korea, are also subject to targeted financial sanctions. which means that specifically for the DPRK, our scope of targeted financial sanctions implementation is rather broad and encompasses quite a lot of the DPRK and entities connected to the DPRK. So it's worth making a note of actually the scope of targeted financial sanctions goes far beyond just the people who are listed on the sanctions list. On the next slide, I just want to briefly revisit the previous definition of funds and other assets. So remember that not only are we not talking about only the people on the list, we're also not only talking about financial transactions, we can also talk about bank checks, shares, bonds, any interest or dividends received from bonds or shares or even bank accounts, property of any kind, so property that is owned or connected to designated entities and persons also needs to be subject to an asset freeze measure, and of course vessels. So on the next slide, I also want to point out, because this can seem pretty prohibitive, and I absolutely agree that it is very broad scope. So the UN also provides for mechanisms by which legitimate transactions can still be allowed. And there are various authorizations and exemptions that are established at the UN level, authorizations and exemptions to target financial sanctions that have been passed. The first is that any designated party is allowed to access their assets under limited circumstances, such as for basic living expenses or for extraordinary expenses if authorized by the United Nations. So for example, in London, in the UK, there is a basic living allowance that sanctioned entities are allowed to have. And that, of course, needs to be facilitated because they do need the money and the funds to survive. There are also humanitarian exemptions. So any transactions or any shipment of humanitarian goods are exempted from these sanctions if also the United Nations has approved it. For Iran in particular, certain payments that are due under contracts that have already been entered prior to that person being listed are still allowed and can be authorized. And it depends on your domestic legal framework, but there are some things that individual member states are required to verify, such as end users or the contents of a shipment. So in a domestic approval process, and some things go directly to the UN Sanctions Committee, but also with your country's kind of sponsorship of that request. So again, consult your domestic legal mechanisms for how the authorization and exemption measures works in your jurisdiction. So really the last slide here, I just want to go over the key points that I think we've established in this presentation. The first is that targeted financial sanctions are essentially, are we on the last slide? I just want to make sure. Yeah, thank you. Targeted financial sanctions are essentially financial embargoes on listed parties. So it applies to those who are on the list, of course, but it also goes beyond that. It means that reporting persons, the private sector, all of you, need to also consider those who are connected to listed parties. That means anyone who's owned by a listed party, anyone who's controlled by a listed party, anyone who's acting on behalf of or acting on the benefit for designated or listed parties. Excuse me. Asset freeze provisions is about both freezing the funds in a bank account and stopping financial transactions from happening. But funds and other assets is also a broad definition and can include traveler checks, letters of credit, shares and bonds, vessels, works of art, commodities, and even in some countries, we've seen office furniture being considered financial assets or assets that the designated party is not allowed access to. So really, this is why targeted financial sanctions apply not only to banks, but there are also important things for other sectors to look at. In the next session, we will look at how you conduct screening for targeted financial sanctions, and importantly, what the threshold is, what sectors need to comply with targeted financial sanctions. And I will provide a little bit of a spoiler alert for that. everyone needs to implement targeted financial sanctions. Targeted financial sanctions is not just about the banking sector. Estate agents, casinos, accountants, lawyers, trust and company service providers, money service businesses, insurance companies, even the public at large, all needs to make sure that they screen for any involvement of designated entities and individuals in the transactions or the dealings that they conduct. And of course, importantly, proliferators and those who are designated, as was established in the first presentation, will continue to employ third-party intermediaries to evade sanctions. And this is why it's so important to look beyond just that list of designated entities in order to fully implement targeted financial sanctions. Great. So that's the end of this presentation. So I guess we have time now for question and answers. Yeah, that last slide I'll just skip, so we can go straight to Q&A.
Thanks, Emil. Thanks very much for covering this very important section and with adequate brevity, but also adequate depth. We are over 20 questions into the Q&A box, and some of them relate to practical application of CPF measures within the private sector, which is exactly what the third session will cover. So I think at this point we'll focus precisely on legal requirements as it comes to targeted financial sanctions in light of the UN regulations. And there's a group, let me say, of questions about the UN Security Council that I would want to you to address first. And it's really two questions, I think. One is there like a comprehensive list of UNSC resolutions and designations that one can consult? The other is what really happens when assets are frozen and action is taken on those UNSC recommendations. Does the Security Council do anything in particular about that, and what are the consequences of actually complying?
Yeah, so it's important to note that the implementation of sanctions is managed by individual member states. So often in a member state, there will be a process for communicating designations, communicating designations that are at the EU level, and often there will also be reporting requirements if assets are found to. In the next session, I will talk more about the specific process. So if you, as a bank, for example, find that one of your customers is now on the list, how do you do the and to more report across that not leasing these assets, the assets are not without prior term exemptions, that kind of thing. And actually the assets are managed during that time because there is an expectation that someone might be removed from a sanctions list again. And it's important to note this. Sanctions are not meant to be for life. At least not in theory. Sometimes in practice, they end up being for life. But sanctions are in place so that they can be lifted again. And once they're lifted, that individual who is subject to sanctions needs to have access to their funds and other assets again. But I'll go in a bit more detail in a bit about how the specific screening and free.
Thanks. Let's dive a bit deeper into Cambodia in particular. Obviously, recognizing that you're not entitled to discuss whatever question which says, how do we basically impose sanctions on a legal entity legally registered in Cambodia? And I think there's a follow-up question to that in the chat box I see, is that can the application of targeted financial sanctions be defined as basically following the list sanctions from the UN and FATF?
So the international legal requirement is to implement the sanctions list by the United Nations. There are also other countries that have unilateral sanctions, but in Cambodia, you only need to look at the UN list and any list that the Cambodian government. And I don't know, and I don't know to the extent to which Cambodia has their own sanctions list. But the UN is the international requirement. That is the requirement that all member states will oblige by. The other question: how can we implement? What was it? Let me just make sure I got that question right. It was about how can we enforce sanctions against a legal entity in Cambodia.
Yes.
So that will be spelled out by your regulator or your regulatory authority, who will set out their expectations for how you enforce these sanctions in practice. But for our purposes today, it doesn't matter if your client is based in Cambodia, or if your client is based in Thailand, or if your client is based in Dubai, or if the transaction involves an entity in the UK. If it's a sanctioned entity, no matter where it is located, that transaction involved needs to be frozen and not made available to that designated entity and person. So if it's an entity in Cambodia, there will be some domestic reporting requirements, but those are set out at a domestic level. So I won't be able to cover those today.
Great. I think you've partially addressed it already, but let us reiterate perhaps. Besides UN and FATF, other targeted sanction lists designated by US and EU should be considered as an action point for freezing the assets, or not really?
So the international requirement is to implement United Nations targeted financial sanctions, so the list passed by the United Nations, as well as any domestic requirements in the jurisdiction where you operate. It is entirely your choice if you choose to consult other sanctions lists, and you can do that both because you have maybe exposure to other jurisdictions that have unilateral sanctions lists, or it's in your risk appetite, but that decision is based on risk appetite, not legal obligations. So the legal obligation is UN and Cambodia only.
And at the end of the process, how does the UN Security Council monitor and take action on all these sanctions once there is compliance at the country level?
Yeah, so the United Nations has established something called the panel of experts related to North Korea and Iran. And those panel of experts, actually any sanctions regime that the UN passes, there is a sanctions committee attached to that sanctions regime that will monitor monitor the implementation of those sanctions by every member state. And member states will sometimes submit reports to the UN informing the United Nations of any instances of sanctions evasion that have occurred in their territory, or if they found any assets in the territory of a sanctioned entity. But again, the United Nations role in sanctions is really just in the design. So choosing this is the entities, individuals who are on the sanctions list, and then it is up to the individual member states to monitor and enforce those sanctions. The United Nations does not have enforcement capabilities per se against individual businesses or private sector entities. That is up to the member states to do that implementation piece.
Thank you, Emil. I think we have reached the point at which most of the questions are more into the nitty-gritty detail of TFS application at the private sector level. Perhaps as a taster, and this is kind of a leftover question from the previous session, you could give us some examples of how PF applies to real estate agencies as we transition to the third and final session.
Yeah, I can certainly talk a little bit about the real estate sector. So because funds and financial assets and economic resources also includes property, if there's any property that is owned or leased by a designated party or anyone connected to a designated party, that property would be subject to an asset freezing measure as well. There are also other instances that we've seen in typology. So, for example, if a designated party is involved in the construction of properties, sometimes targeted sanctioned entities will seek to raise revenues by providing construction services, building services. If that construction or building at some point involves a real estate agent, for example, for selling the property later down the line, there is a nexus there and there's an exposure there to a sanctioned entity. But the clearest one is really the owning of property by the sanctioned entity in particular. If you don't mind, Wojciech, there is one question I just want to quickly address relating to the basic expense stuff. I just want to quickly cover that. A question asked, is it London law that the targeted personal entity of sanctions can use the assets frozen for basic expenses? So it is a UK law that sets out what the basic expense is in the UK. And I believe in London, there's a London basic living allowance for sanctioned entities of £2,500 per month. And I'm not sure if they pay tax on that or not. It's a good question. But that is the basic living allowance that is authorized by the UK government. And if you're a sanctioned entity based in the UK and you rely on access to your UK assets and funds for basic living expenses, you apply to the UK government, go through a lawyer, apply to the UK government to have that basic living expense authorized. So yes, it is in UK law. I should note that it's probably also in European law because we've only recently left the European Union and transposed all of our laws from the European Union into British law. So yeah.
Perfect. Thanks so much. I think we've reached the point at which we can transition to the third and final session. So back to you, Emil.
Great, thank you so much. So the final session will address some of the questions that have also been raised about how to do this in practice. We want to talk about the things that are required for private sector entities, such as all the ones on the call today, to implement all of these measures in practice. How do you integrate targeted financial sanctions related to proliferation into your compliance program? What are the specific steps that you need to go through? And how do you kind of go beyond just doing the basic level of due diligence and compliance? We will also talk a little bit about how you can make your implementation even more effective, recognizing that sanctions evasion is such an important component of the implementation of targeted financial sanctions. Combating sanctions evasion is such an important component. However, before we get into the specific implementation steps, Sasha will be talking a little bit about private sector awareness and some of the stories that we've picked up from around the world doing these kind of trainings that might also correlate to some of your understanding about proliferation financing and the implementation of targeted financial sanctions related to proliferation. So Sasha is here to debunk some of these myths and situate us within a nice context before we proceed with the rest of this session.
Great, thanks Emil, and hi to everyone again. So as mentioned in this session, I am going to focus more specifically on sanctions evasion in the private sector, as well as effective implementation. So while the private sector has experience in countering other types of financial crime risk, this includes money laundering, terrorist financing, fraud, and corruption, there is less evident industry-wide understanding of how to effectively counter proliferation-related activity, which leads to sanctions evasion and poor implementation of those sanctions. On the next slide, I'm going to expand on this. So governments can, of course, establish the foundation for an effective proliferation finance response. However, despite these well-warranted efforts, recognizing when sanctions are poorly abided by or being evaded also crucially depends on the involvement of the private sector. Indeed, the response will be highly uneven without private sector implementation. We will see this more on the next slide, which I'll proceed to now. So as you can see in the speech bubbles on this slide, a lack of awareness of the ways in which sanctions can be evaded, alongside the limited understanding of them in the private sector, is regrettably somewhat rife. These captions indicate what some private sector individuals say about sanctions and proliferation finance. And we can start with the assumption that sanctions on a certain entity or country no longer apply. Therefore, a company, industry, or business does not need to have any policies in place to counter this. However, by not having any sanctions compliance policies, a company or industry will render themselves increasingly vulnerable to exploitation by designated entities, as sanctions compliance and policies measures are required to be in place, regardless of whether those sanctions exist or not. Another example that we see in the speech bubble is that of not processing nuclear weapon payments. So whilst this is a key step, abiding by counter-proliferation finance sanctions fully goes beyond the simple delivery of fully assembled weapon systems. And often small parts of the weapon, such as fuel or dual-use items, are used to further proliferation programs. By not being aware of the multitude of dual-use items which can be used to finance and procure nuclear weapons, and relying on recognizing a finished product, the private sector renders itself increasingly vulnerable to missing key aspects of sanctions evasion, as designated parties will seek to exploit these weak points. Companies can also face serious penalties with regulatory authorities, whether domestic or international, for failing to be aware of the multitude of dual-use items and smaller products which are used in the assemblage of a nuclear weapon. This, of course, is similar to the speech bubble, which reads, "Our internal policy is not to engage in arms shipments." Indeed, sanctions implementation relating to proliferation finance does go far beyond arms shipments, and it is often dynamic, not in the form of weapons themselves, and difficult to recognize. So a payment may not be listed as pertaining to arms, and once again, financing nuclear weapon programs exceeds simply assuming the products and amassing those needed for the assemblage of said weapon or for the production of the program. This is an assumption designated actors frequently take advantage of and may exploit to their advantage to continue to evade sanctions when conducting business with various companies who are engaging in the production of dual-use goods. So, as we can see, proliferation finance is a discrete and highly obfuscated activity which requires vigilant government and private sector cooperation to recognize risk and unusual or fraudulent payments of any category of goods. And this can be done by incorporating and complying with international sanctions requirements. So in another speech bubble, we see that a company has not done business with designated parties since 2007. Whilst this is certainly an achievement and demonstrates compliance, it fails to consider how these countries frequently make use of third-party individuals and companies, use dual nationals, or create elaborate obfuscation tactics to avoid being recognized. Lastly, we can see in the final speech bubble that some companies rely on up-to-date screening activity to avoid inadvertently evading sanctions. While scanning suspected persons against a list does have limited effectiveness, it is also restricted to recognizing third-party entities or individuals acting on behalf of a listed party. As the next slide was going to discuss, recognizing unusual activity-based tactics is key to abiding by sanctions. So on the slide, we see that it is important to note that implementing sanctions goes far beyond scanning designated parties on a list. Not only are there a range of evasive tactics used, but designated actors also know when their name is on a list. Those listed by the United Nations should have their assets frozen. However, action should also cover individuals and entities who are acting on behalf of or at the direction of, whether directly or indirectly, of designated persons and entities, as well as those owned or controlled by the designated parties. And finally, those who may be assisting the designated parties in evading sanctions or violating resolution provisions. So, as we can see, it is critical that countries and the private sector alike have sanctions regimes which go beyond list-based screening, and that an array of industries recognize both the techniques and the situations designated actors use to evade sanctions. In the same vein, an over-reliance on simply screening for any mention of designated entities rather than investigating the possible presence of complex networks, which may include front companies and middlemen on which designated parties rely upon to obscure their involvement, will leave the private sector vulnerable and exposed. Indeed, without a deeper assessment of the clients, which could include seeking to understand what the client's trading activities are, where they are operating, and to whom they are connected, we will have little way of knowing if a connection to a sanctioned entity truly exists. This, of course, will lead into the various obfuscation tactics which designated entities will use to evade sanctions, which I'm going to discuss now on the following slide. So, another key piece of infrastructure that supports sanctions evasion activities is the series of corporate networks which can indicate hiding certain illegal activities. While information like company addresses or the names of businesses should be fairly easy to procure, other details, such as management structures, may not be immediately obvious. These networks therefore allow designated entities to make and move money despite international sanctions by hiding the connection between its sanctions evasion activities and by benefiting from these activities in doing so. Effectively, we can see that these corporate networks may be used in support of designated actors' sanctions evasion tactics in various ways. One example is when entities within these networks may establish joint ventures with otherwise legitimate local businesses, or use foreign nationals in their operations in an attempt to hide their connection to the designated entity. Similarly, designated entities often use variations of the same corporate name and have been known to transliterate into different scripts, all of which helps disguise their connection to sanctioned parties. So some more common obfuscation tactics, which we can see are listed on the slide, we will talk about now below. These include the use of front companies, shell companies, joint ventures with legitimate businesses, and complex and opaque ownership structures, the indirect routing of transactions, and the mixing of licit and illicit business also form a part of these evasive categories. Similarly, the use of non-sanctioned individuals as financial facilitators and the use of ledger systems to track value transfers which will not indicate a physical connection to the designated entity is a key obfuscation tactic. Finally, we can see that disassociating logistics from the financial trail can indicate hiding important information, and all of this can heighten the obfuscation tactics which designated actors will use in order to engage with other legitimate companies and businesses. So that is all from me for now, and I would like to take this chance to quickly thank all of our esteemed guests for this opportunity to further discuss the evasive tactics used by designated actors in sanctions. And I really do hope that you have learned something this far. I will now hand back over to Emil, and he's going to discuss the equally important topic of sanction screening and undertaking effective implementation in this area. Thank you.
Thanks very much, Sasha. I see lots of questions coming in, so I want to make sure we leave time at the end to answer all of those questions. But the next part of the presentation, on the next slide, you'll see that we'll be talking about consultation of sanctions lists. So how do you implement these things in practice? And I will go through step by step of how to conduct screening and implement targeted financial sanctions, and hopefully that will answer some of the questions. The first step is to consult sanctions lists. And it's important to consult sanctions lists every time they are updated. So every time there's a change to a sanctions list, that you need to be aware of that change. That both relates to any new designations. So if there's a new person or a new entity that has been added to the sanctions list, any changes to existing designations, that can be if the date of birth is updated or there's a new alias that is added for a designated party, or a new address or a new phone number. Sometimes the records of sanctioned entities are updated, and any of those updates needs to also be incorporated into your sanctions compliance programs. And finally, there's the possibility of any removed designations. So if the United Nations makes the decision to remove someone from the sanctions list, of course, you need to be aware of that change, so that you can unfreeze those assets and allow that person to now be able to operate in the international financial system. So the FATF requires that sanctions are implemented without delay. And it's difficult to put a specific target on what the FATF means by without delay, but it is definitely the case that we're talking about hours rather than days. So within hours of any changes to sanctions list occurring, these changes need to be incorporated into your compliance program, and you need to have conducted and screening on those, be aware of those changes. So you, as a reporting person, have a responsibility to monitor and implement any changes immediately when they happen at the UN level. There is often a domestic mechanism for disseminating changes to any relevant sanctions list directly to private sector entities, but you may also consult the UN lists directly, and you can do this simply by going on the UN's website, and you can download the sanctions lists directly from the United Nations, and that's where the updates would be posted in the first instance before they're then transposed into domestic law and domestic designations. But it is your responsibility to be aware of these changes. So on this slide, I want to talk a little bit about sanctions screening. What do we mean by when we talk about sanctions screening? So sanctions screening is essentially the comparison of these sanctions lists, the comparison of the information on the sanctions list with any customer and transaction data that you have in your organization, in order to detect any potential matches. So if there is a similarity or a match between someone who's on a sanctions list and someone who's contained in a transaction that you are processing, that is a potential match and could be a sanctions violation. And that's kind of what sanctions screening refers to. Most banks will use automated screening software. So a software that automatically screens any incoming and outgoing transactions and automatically screens overnight customer data to make sure that there is no match with a sanctions list. But there are also some smaller banks or some business lines within banks, like trade finance departments, that often rely on manual screening. And there are also many other sectors that don't have automated screening software as standard and rely on manual screening. So manual screening sets the bar no higher, no lower than automated screening. Every time there's a change to a sanctions list, that change needs to be compared and look for a potential match within your customer and transaction data. It's important to emphasize that there is no exception to when you must do sanction screening. Sanctions apply to all clients and all transactions, no matter how long a client has been a customer. And it applies to all transactions, no matter how regular those transactions are. And there is no minimum financial limit or threshold for when sanctions apply. And this is a little bit different from money laundering, where there's often a threshold for when certain reporting requirements kick in. When it comes to sanctions, there's no financial limit or any limit on the size of the transaction or the funds involved. Even if it's just a transaction of $1, it needs to be compliant with sanction screening. So on the next slide, I'll go through the first type of screening that we have, and that is customer screening. So you as a private sector entity should have a procedure that allows you to screen your customers, both during onboarding, so when a new customer approaches you to become a customer with your business, but also regularly throughout the life cycle of the customer relationship. So at regular intervals throughout the life cycle of the relationship, do you need to screen customers against and the details against sanctions lists for any potential matches? Because while a customer might not have been exposed to sanctions when they onboarded, later down the line, 10, 15, 20 years down the line, that situation might change. The things that needs to be screened against includes both the account holders and any signatories to the account, any directors and beneficial owners of corporate customers. So this is the bit about sanctions apply not only to the designated entity, but also any entities that are acting on behalf of or controlled by or owned by designated entities. So directors are ultimate beneficial owners. As well as anyone who have access to the account or exercising control over the account needs to also be included in sanction screening and customer screening procedures. And it's up to you to set out when you want to conduct customer screening. But at a minimum, I would say that screening should be done when establishing a new customer relationship. So at the onboarding stage, at specific trigger events. So when there's a change in directors or a change in ownership or a change in the address, because that change in directors' ownership or addresses might illuminate a connection to a sanctioned entity that wasn't otherwise obvious. So for example, if a corporate customer changes their address and you find out that address is co-located with the address of a sanctioned entity, that would cause you to trigger an investigation into what's going on, what might be happening here, why are you now sharing an address with a sanctioned entity? Is it a joint venture? Does the sanctioned entity have any involvement? And it could simply be that they are in the same office block building, and that's the end of your investigation, but it needs to be consulted. And any changes to sanctions list, so anytime there's a change to sanctions list, that change needs to be run through your entire customer database. On the next slide, I'm talking about transaction monitoring. So on top of customer screening, each incoming and outgoing transaction must be screened for potential match with sanctions lists. For example, any parties that are involved in the transaction, whether it's the remitter, the beneficiary, any other financial institutions that are involved, correspondent banks or intermediary parties, needs to be screened for potential match with sanctions lists. It also includes vessels and IMO numbers of vessels that are involved in the transaction, because those vessels and IMO numbers can be designated themselves. It includes bank names, bank identifier codes, and other routing codes, because it might indicate the involvement of a designated bank or designated financial institution. And it includes the free text fields, so the payment reference. Sometimes there might be a reference to a person or an entity or a good that is subject to sanctions. So even if there is no sanctions hit, and even if a transaction doesn't show any immediate connection to someone on the sanctions list, you should still pay attention to any indication that information has been removed from the transaction, or any signs that the transaction inhibits any signs of sanctions evasion, because that might still, if there are common signs of sanctions evasion, and we went through some of those signs earlier in the first presentation, and they will be in the slides that will be sent to you. If any of those signs are present in the transaction, it might mean that a designated party is actually involved at some stage, or there is sanctions evasion taking place, and you need to do that extra due diligence to make sure that that is not the case. Great. On the next slide, I'll talk a little bit about what to do when a potential match is found. So just because it's important to point out, just because if you have automated screening software or you have manual screening, if you find similarities between a sanctions list and one of your customers, it doesn't mean that that is automatically a sanctions violation. Investigation needs to be done to confirm or deny whether it is actually a sanctions match. So at the stage where a potential match is detected, and if you maintain any accounts or holds or controls any funds or other assets that are owned, controlled, or acting on behalf of or for the benefit of designated parties and entities, you must immediately freeze those assets and those funds and other assets, to not make them available, even if it's on suspicion. Not make any other funds or assets available, so that means stopping any transactions that are ongoing, and then investigate further. It is not a permanent freezing order, it is stop, wait, and investigate. So when you investigate, you need to resolve whether it is a true match or whether it is a false positive. As I said, potential matches with a sanctions list is not an automatic indication that there has been a sanctions violation. It could simply be that someone, one of your customers, has a very similar name to someone who's on a sanctions list. It could also be that there is an overlap in addresses or common surnames related to certain countries, any abbreviations or differences in spelling that make it so that it looks like there is a sanctions hit, but actually further investigation shows that there is not a sanctions hit. And the UN sanctions lists include several points of additional information that can help you identify whether it is a true match or a false positive. Provides things like date of birth, provides things like common aliases, it provides a description of who the person is and why they've been designated that might help you resolve whether it's the same person or the same entity. So you might find that actually your sanctions match is a false positive, and at that point you don't need to do anything further. The target financial sanctions does not apply to that transaction, to that customer, if it is a false positive, and that will happen quite often, the detection of false positives, depending on where you set your risk appetite. So in a automatic sanctions screening software, you can set a threshold for how close you want the software to screen. So for example, if you set the threshold quite high, it will pick up more false positives because it will look for more sort of tangential connections to sanctioned entities, or matches or overlaps. You can also set the threshold low, where you will eliminate more of the false positives, but you could potentially also end up overlooking some true matches that might show up. If you have a true match, if you've established that actually this transaction or this customer is a designated entity, or is controlled by a designated entity, or is acting on behalf of a designated entity, reporting obligations. So the asset freezing order stays in place. You're not making any funds and other assets available, but there will be a domestic reporting mechanism for you to report that a true match has been detected and then you're now holding assets that are frozen. So it's important at that point to be aware of your domestic reporting obligations. I can't talk about those on the training today because those are established in Cambodian law and are important for you to consult with the relevant authorities. So on the next slide, so that's kind of your basic level of implementation, screening for sanctions, and if there is a match, freezing those assets. But realizing that listed parties, those who are designated, will rarely, if ever, show up in a transaction themselves and will instead make use of these complex networks of front companies and intermediaries to conceal their involvement in financial transactions. And evidence from the United Nations saying that proliferation financing actors have been using third-party intermediaries who are not themselves listed in order to continue accessing the financial system. There are certain ways that you can enhance your implementation of targeted financial sanctions to make sure that you capture those risks. So one is to familiarize yourself with common sanctions evasion techniques of proliferators, which we outline in presentation 1 of today. And we'll also provide some resources after this call for where you can educate yourself about common sanction evasion techniques, primarily through the UN Panel of Experts reports. But it's also about being aware of these situations that might present a higher risk of proliferation financing. And on the next slide, there's a list of some of these situations that you should be aware of that might indicate that sanctions evasion is taking place and might warrant further investigation. So on the next slide, you will see a list of situations that might present higher proliferation financing risk and might warrant enhanced due diligence. I'll just highlight a few of them. If you have any customers who are linked to high-risk countries or business sectors that are specifically connected to proliferation financing, so if you have customers with links to a proliferating country or a customer who is involved in a dual-use goods sector, those customers might have to undergo enhanced due diligence because they might be more exposed to sanctions evasion attempts. Any customers who have unnecessarily complex or opaque beneficial ownership structures should be investigated further, or any customers who have frequent changes in directors or their beneficial owners is often connected to sanctions evasion. Of course, it's normal to change owners and directors for a company, but it is also a fact that if say a director of a company is designated, the company will very quickly change their ownership and their directorship in order no longer to have a connection to a sanctioned entity. So it's important to figure out that actually a frequent change and a company that keeps changing their owners and directors might be a sign that sanctions evasion is taking place and might mean that there is involvement of a sanctioned party or entity. Any customers who have previously had dealings with any individuals or entities that have been designated for proliferation by UN Security Council, by the UN Security Council. So you might have customers where your historical records show that they previously dealt with entities and individuals who have since become sanctioned. They might have stopped those interactions with the sanctioned actor, but you need to verify that those activities have definitely been stopped. And you might want to put in place enhanced due diligence in order to make sure that no transactions and no ongoing dealings still involve those individuals and entities. Any customers who have entered into joint ventures or cooperation agreements with designated entities and individuals. Any customers who are involved in trading, brokering, or intermediary services and might be used by sanctioned entities as a middleman, and any business that carries out business activities that is inconsistent with the normal business practice that you would expect to see. So at onboarding, you would ask the customer what do you do, what kind of what does a normal transaction pattern look like for your business, and if the transaction pattern starts diverging from that, that is a red flag that you would want to raise. I'll just go through the last few ones here. Transactions or trade with any countries that have been known to be exploited by proliferation financing regimes, or any neighboring countries to proliferation financing regimes. So Iran and North Korea are specifically designated by the United Nations, but so it's unlikely that you will see direct connections to those countries. But what about the neighboring countries? Is that something that you might want to look a bit closer at in terms of detecting sanctions evasion? Great. The next slide talks about understanding proliferation financing risk. A large part of effective implementation of sanctions is understanding the sources that are available to you and the resources that you might consult and the knowledge that you have on this topic. So it's important that in order for you to be able to detect the involvement of sanctioned individuals and entities, that you are aware of proliferation financing typologies and reports. And I would definitely recommend the UN panel of experts on North Korea, who every 6 months issues a report that details the latest trends in sanctions evasion by sanctioned entities, and sometimes includes quite detailed information on activities that are going on in different countries, and helps you make an informed decision about what your exposure might be to sanctions evasion activities by designated entities. You might consider a risk assessment to understand how specific customers, how specific supply chains, intermediaries, or counterparts, or products or services that you offer have higher or lower exposure to proliferation sanctions related risk. But this is very much done based on your risk appetite. So your minimum requirement is to do the screening. All of this on this slide is to enhance your ability to do the screening. And it's basically done on your risk appetite. The table that's displayed here is from a survey that we did with ACAMS, the Association of Certified Anti-Money Laundering Specialists. And they're an organization of compliance officers from around the world. And we asked, we did a survey with ACAMS where we asked the ACAMS membership about how familiar they were and where they got their knowledge on proliferation financing from. And these are all private sector responses. And you will see that most people said that they were aware of proliferation finance red flags and typologies. A lot of people said that they have read Financial Action Task Force guidance on proliferation finance, which was issued in 2018. If you have not read that guidance, it is meant for governments, but it is also very useful for private sector entities because it includes a list of red flags and indicators that you might look for. A lot of people said that they stay up to date on the latest sanctions evasion activities through news reporting. So that's another source that you can consult. Stay up to date on sanctions evasion news in order to be informed about the latest trends. A lot of people said that they consult advisories issued by governments, primarily the United States, who have issued a lot of advisories on this, but also other governments have issued guidance papers. So have think tanks and non-governmental organizations like RUSI, CNAS in Washington, or King's College London has also produced several reports and typologies that might be useful. However, disappointingly, only 13% said that they read the 6 monthly reports issued by the UN panel of experts. And I would say that your most crucial source of information on proliferation financing and the activities of sanctioned individuals and entities comes from the UN panel of experts reports. So if I can leave you with one recommendation from this training, it is have a read of one of those reports, look through it, see how it might be helpful to educating you about your risk exposure to PF sanctions and targeted financial sanctions. Great. So the final slide here is just an overview of the tools and resources that you can consult. And we we can make well, you'll get the slides, so you'll see these tools and resources yourselves. But I already mentioned think tanks like RUSI, King's College London, and CNAS, who have all issued really useful guidance and typology reports on proliferation financing. Normally, we would go much more into detail in a training like this on specific typologies, but given the virtual format, we are unable to do that in full today. Also consult the FATF guidance and typologies that have been issued on proliferation financing. Consult the tools and resources that are issued by the UN sanctions committees or the UN panel of experts reports. Are also really key to understanding how your business might be exposed to sanctions evasion and your requirements. So that's the end of my presentation here. But there is one thing that I just want to do, if Wojtek will indulge me. I would like to get the first presentation back up. I'd like to have the second to last slide, case study 2, because I have 5 minutes now, and I think a lot of the questions that have been asked will be answered by using that case study, and it will provide quite a nice wrapping up of the session today.
Sure, Emil. I was exactly thinking the same. So
Good.
let me just bring it up, and we'll fire away.
Great. Thank you, everyone, for submitting your questions. In 5 to 10 minutes' time, I will make sure we answer some of those questions. So please make sure you submit any questions if you have anything further while Wojtek gets this presentation up. So the case study that I would like to go through here at the end, I think exemplifies really well the risks here to a bank, but hopefully it encapsulates everything that we've talked about today. The case study is called Chinpo Shipping. Some of you might have heard about this case study before because it is a very famous proliferation financing case study. It was a case study in Singapore, and it was actually, to the best of my knowledge, the first proliferation financing case to be prosecuted. And the Singaporean authorities prosecuted this case as proliferation financing as opposed to money laundering or sanctions evasion. It was specifically prosecuted as proliferation financing. So in this case, it started with a ship that was traveling in international waters and was stopped. And on board the ship was a number of items that were prohibited for sanctions on the ship, and the ship was connected to a designated entity or sanctioned party, in this case, North Korea. An investigation showed that a Singaporean shipping and maritime service company called Chinpo Shipping Company had provided some of the payment fees for this vessel to go through the Panama Canal. So in order to pass through the Panama Canal, you need to pay a fee, and Chinpo Shipping Company had organized this fee on behalf of the ship. So the Singaporean government opened an investigation into Chinpo Shipping Company, and they found out that the bank account of Chinpo Shipping had essentially been used by another company for more than 4 years. Another company called Ocean Maritime Management had made use of Chinpo Shipping Company's bank accounts. Ocean Maritime Management is the state shipping company of the DPRK and is now a designated entity. And because it was difficult for Ocean Maritime Management to get access to its own bank account services because banks were unable and unwilling to bank it, it simply went to this small family-owned shipping company called Chinpo Shipping and said, let us use your bank account like our own. So over a period of 4 years, more than $40 million in transactions went through this bank account that had nothing to do with Chinpo Shipping, but was actually Chinpo Shipping doing payments on behalf of Ocean Maritime Management. And one of the charges that were brought against Chinpo Shipping was the operation of an unlicensed remittance business, because Chinpo Shipping was essentially receiving payments and paying out funds on behalf of someone else without being a licensed remittance business to do so. The investigation also found, and there was a question about the involvement of diplomatic staff. The investigation also found that Chinpo Shipping Company was actually co-located with the local embassy of the DPRK, and that a DPRK embassy employee had signing authority over the bank account. And often we will see this as a mechanism to avoid scrutiny. So on onboarding, the bank will see that it is Chinpo Shipping Company, but then later on in the customer relationship, Chinpo Shipping added several signing authorities to their account, and the bank didn't conduct any due diligence or any comparison of against screening sanctions lists when those signing authorities were added, and therefore they weren't picked up as a sanctions risk. So the embassy and embassy staff had signing authority over Chinpo bank accounts and were also using this bank account as their own. So this case study encapsulates several risks, and it shows Chinpo Shipping Company. This bank in question had had that relationship, customer relationship with Chinpo Shipping since 1973. This case was from 2013. So it shows that 40 years later, the risk suddenly changed for this bank. And unless you do that ongoing due diligence throughout the customer relationship, you're unlikely to pick up on some of these indications that sanctions evasion might be taking place, or there might be an involvement of a sanctioned entity or party. So while Chinpo Shipping Company wasn't itself designated, it was acting on behalf of or at the direction of designated entities and processing transactions that were prohibited on behalf of the DPRK. So I wanted to wrap up with that case study because I think it encapsulates everything that we've talked about, and the importance of doing sanction screening that not only looks at your customer at onboarding, but actually looks at the lifetime of the customer relationship, and also takes into account any actors that might be connected indirectly to the customer on your customer sheet. So that's it, and I will now we can proceed to questions. We're a bit ahead of time, which is probably not a bad idea considering we have so many questions that have been submitted.
Exactly. So I will now stop sharing this, but we'll dive straight into questions. And I think, Emil, if you don't mind, I know you've marked a couple of those that you would want to answer, but I think we should start with the one sitting at the very top that has been there for a while. And also, before we do this, I wanted to flag to the interpreters, because I think we've asked a couple of times that there is a question in Khmer around midway Q&A that requires translation that we will not want to see. If you could just pop it into the chat for us, that would be great. So, to the question, for proliferation financing, many entities usually use trade finance. For example, I see your fake documents to avoid being monitored. So, what can banks do to find out about such activity?
So the falsification of documents and false information supplied on letters of credit can be used by a number of actors, illicit actors. It doesn't just have to be sanctioned actors involved in proliferation financing. So some of the same tools and mechanisms that you employ to detect fraud or evasion in your trade finance business will also be applicable to proliferation financing. But perhaps for proliferation financing, what is a little bit different is that you need to pay particular attention to the goods that are declared on the letter of credit, because the goods might give you an indication of whether it is related to proliferation. You might want to consider a different set of exposure points the process that is prohibited. It's the eventual end use.
that relate